Thanks for joining me in this very special interview. Today we shall look at the economic conditions of the country, and I have with me a very distinguished panel. Joining me are the chief economists of the 3 or 4 biggest banks in the country. Over there I have Vincent Lu, he's the senior economist of RHB Group. To his right I have Dr. Hanna of CIMB, he's the group chief economist of CIMB. And nearest to me is Suhaimi Ilias, the group chief economist of Maybank. Gentlemen, thanks for joining me today. Before we go deep into any of the topics, let's take into stock what has happened over the past 3 quarters. We've just closed September. What are the key things that would be taken into highlight? Maybe we'll start with Vincent first.
Hi, thanks for having me. In the past 3 quarters, in 2017, probably we have seen trade actually strengthen in 2017. And towards the first quarter, probably we've seen some slowdown in external trade. This has actually caused economic growth for Malaysia to actually slow down to 5.4% in the first quarter, down from 5.9% in the fourth quarter of last year.
So maybe we can draw some attention into some of the data that Maybank IBO Research are pulling in. What are the 3 or 4 key factors that you've seen that has happened throughout the year?
Well, I think there's a combination of domestic factors and external factors. Just to build on what Vincent has said just now, we are looking at economic growth to be a little bit slower this year, averaging around 4.8% after the almost 6% expansion last year. Not because there's something that is fundamentally wrong with the economy, but I think we have to acknowledge the fact that we are going through a period of adjustment. And the key factor for that domestically is the change in government after the 14th January election back in May. And I think that has resulted in some major policy shift concerning consumption tax, concerning fuel subsidy, reviews, postponement, cancellation of major infrastructure investment projects. So all these have impact on components of domestic demand like consumer spending, public expenditure and corporate investment. At the same time, there's a lot of things happening externally. There is this escalation of US-China trade tension or trade war. We have pressures on emerging market currencies. We have also some rising concern on geopolitical front, and also there is this situation where we are seeing global interest rate is rising, and we're also seeing a situation where the major central banks are beginning to unwind their quantitative easing. So what I'm trying to say here is that we have to get accustomed to the kind of adjustment in policies and political situation that will have some what we think is a temporary effect.
I think Malaysia, given how open it is and the size of the shock and uncertainty that's being generated by the change in policies in the US, is doing a very good job. The problem, of course, is there's still some uncertainty because you have a new government, and naturally on the investment side, after very high levels of investment last year, which contributed as well as the external picture to the high growth, that's naturally going to take a moment to pause and figure out what's going on next. There are some elements of the changes that are going to boost growth and already have, in particular when you take the sales tax down, or I should say the GST tax down, and say a new tax is coming, households are going to spend money before that new tax comes. So the third quarter number on the consumption side should be stronger. Yeah. It's going to get a little bit weaker now that the tax is back, because you would have bought all those cars as quickly as you could when they were cheaper. But that kind of adjustment is natural. I think the next really crucial aspect that will matter for how private investment in particular performs is how the market receives the budget. So far, the government has been talking about continuing to have a process of consolidation that manages the debt burden of the country responsibly, that deals with creating a more efficient basis for the private sector to grow through public infrastructure investment. But we need to see the details, and that will, I think, be a crucial catalyst.
No, you're not alone in asking for details. I'm not just talking about economists such as yourself.
with the adjustment of the tax holiday and SST being introduced in September, I think we should be fair. I mean, so in the months of September and October, you'll probably see spending slow. But then key thing to look after is on the numbers in November and December when the festive season kicks in, whether the buying sentiment will still be there, and going into 2019 next year.
All right, the budget is a big topic. It's going to happen very soon, less than a month from now. Do you think that some of the major surprises are going to be seen?
I think first and foremost we have to be realistic in our expectation. I don't think people should be hoping for another round of goodies budget, like I guess what we are familiar with or accustomed over the past few years. Right at the beginning of this new government, they have highlighted the challenges that the government face in terms of its financial situation, with this expose about 1 trillion ringgit debt and liabilities that the government have to deal with, plus the fact that I guess the 1MDB debt burden is something that the government have to bring into its book now, and something that they have to deal with going forward. So I guess that put in the context of how this budget is going to be. But ultimately, I think it will be a good budget, good in the sense that the government will continue to maintain fiscal or financial discipline going forward. We do expect the government would try its best to make sure that our budget deficit to GDP ratio don't go beyond 3%. If possible, would keep it at least the same with what is targeted for this year at 2.8% of GDP. I mean, the question is how are you going to do that? I think that's the key question. I think a bit limited on revenue front because they have to deal with this net consumption tax revenue loss of about 20 billion plus as a result of migrating back to SST and abolishing GST. There is that issue of GST and income tax refund that is still outstanding. So how they're going to deal with that within the context of what sorts of revenue sources that they can count on to fund the gap, and what kind of spending measures that they have to undertake to make sure that the budget doesn't balloon or get out of control. I think from revenue perspectives, at least a couple of areas that we do expect. One is a bit of a relief in the sense that crude oil price is firm. It looks like it can be higher than what originally expected in the original budget 2018. So we can expect some boost to a government oil-related revenue. Already Petronas has pledged to give extra 5 billion ringgit in terms of dividend to the government. Of course, but
we can't expect much more goodies from Petronas, of course.
There's a limit to that, obviously. Petronas also need the money for their own capex purpose and so on. I guess at least in the short term, or at least within budget 2019, from the revenue side, we should pay attention to what the government can do to boost non-tax revenues. Things like what has been mentioned in terms of asset monetization or asset sales by the government. So I think that's going to be one of the key features on the revenue side.
Don, do you think we should brace for a very bare minimum budget with no goodies in hand, or this is the new reality that we've got to deal with?
I think it's the new reality one has to deal with, and that what one wants to count on is that the expenditures that are made are better targeted, that the investments in particular come in at a lower cost and yet still generate the kind of spillovers to the private sector that Malaysia needs. And I think that can happen. Right? Some of that's already been in evidence in the renegotiation of existing contracts at much lower costs. The other point I'd make out is that with regard to the revenue loss on the consumption taxes, i.e. the shift from GST to SST, remember, there was a big run-up in refunds that didn't come back, and one needs to deduct that from the amount of revenue that was collected. So the shortfall isn't quite as large. That 20 billion, it's actually somewhat less than that because of the increase in the arrears that the previous government was running. So the gap on that side isn't quite as large. The problem is many of the expenditure cuts that have been announced associated with high-profile infrastructure projects weren't or aren't in the federal government budget. They're on the books of the public sector, broadly defined, associated with the government-linked companies. So when one wants to look then at what's going on with fiscal policy, one needs to actually take that broader perspective and fold in the profit and loss of the government-linked companies, not just the federal government. So while I do think the finance minister is committed to a 2.8% budget deficit as a share of GDP, what's really going to matter, and think about from the credit rating agency's point of view or from the macro effect on the economy overall, is that broader concept that includes the GLCs.
All right. We're gonna take a pause for this for now. But when we come back, we'll discuss a little bit more on the consumption expenditure. Don't go anywhere. We're back. You're watching a very special edition of this episode where I have with me three very distinguished guests, the big bosses of the economists in the banks of Malaysia. We were earlier on talking about the expectations for the upcoming budget, and of course a little bit of a review of what has happened throughout the year, anywhere from change of government, which is a small matter for us, I suppose, versus the bigger issue, which is the drop in the consumption revenue. And Don, you were touching a little bit on that, particularly on how we have to have a 360 view on the balance of the budgets and balance of the books. Vincent, maybe you can chime in on this. How do you think the economists are going to expect from the fall of the revenue, and how do you think this will impact our fiscal policy and perhaps our monetary policy as well?
I think this budget will be the main theme will be a reform budget. Basically, we're looking at fiscal reforms and economic reforms. Already we hear that there will be a zero-based budgeting, where budgeting starts from scratch and not like previously where you inflate it from the previous year's budget. So I think a lot of wastages can be reduced from here. And also we talk about the open tender in the procurement system, and this will actually reduce a lot of leakages in the system, and this will help the expenditure side of the equation. I'm optimistic that this budget we are able to maintain at the 2.8% of GDP, the same as this year.
Right, and with the tax holiday that happened, 3 months, we saw certain numbers picked up, vehicle sales picked up, retail sales picked up, and after the SST was launched, very recently we got this number from the Ministry of Consumer, where there's 2,000 formal complaints being filed daily in terms of SST being improperly executed by the retailers and you know, shop owners, versus the GST, you know, where people tend to complain over, you know, mama shops, but they don't file official complaints. Do you think that consumer or consumerism and spending is really going to take a big blow from the SST execution?
I think the statistic you mentioned just now suggests that consumers are perhaps more aware of their rights, given that there are mechanisms to lodge official complaints with regards to the pricing behaviour of businesses, retailers, following changes in taxation system, for example. But at this juncture, we are not really looking at a complete collapse of consumer spending post-SST, because to me, SST in itself is agreed to be a much narrower tax than GST. I mean, that's very obvious from the perspective of the revenue collected, businesses that are impacted, and the goods and services that are going to be covered by the two taxes, services tax and sales tax. So I think it's unavoidable there will be what you call a pullback in consumption on big ticket items like car, because you can't expect 20 to 40% year-on-year increase in a monthly car sales during June, August, going to be sustained indefinitely. But I guess as far as consumer spending is concerned, there are still other supports or drivers. For example, we still have fuel subsidies. that I think would provide some sort of benefits to the economy, to the consumers in terms of disposable income. Generally, the job market condition is still healthy, with unemployment rate at just over 3%. I mean, when you look at salaries and wages growth in manufacturing and services sector combined, the two largest sector in the economy and the two largest employer in the economy, still a healthy number of around 6-7% so far this year. So I guess on that basis, we are still looking at a situation where we should see for this year consumer spending that is going to be on average still better than last year. Last year 7%, we are looking at 7.6% growth in consumer spending this year. No doubt aided by rather strong numbers that we saw during the consumption tax holiday period. But I think we also have to be realistic and expect some moderation next year. We are looking at probably around mid-6% growth, which is still healthy. It's just that there are certain things that's going to happen next year that could start to affect consumer sentiment a bit, in the sense that fuel price subsidy may be changed system-wise. Rather than everybody getting the benefit of it, it will be more targeted, for example.
Can I just hold on to that? 7.8% expectations in this particular growth in this sector versus the 4.8% GDP growth that you were mentioning earlier. So that means some sectors are shrinking, or else you wouldn't get 4.8. What are the sectors that you think are going to have a slower growth heading towards the end of the year?
I think it's obvious because of the situation that we have now in terms of the review, postponement, cancellation of major infrastructure and some investment projects. I think gross fixed capital formation growth is going to be a bit more subdued than what we have seen before. And of course, the other issue is external trade, something that we need to watch in view of this escalation in US-China trade growth. We may see second half of this year onward a bit more moderate export growth numbers and import growth numbers.
Don.
And lower consumption and lower government spending.
Yeah.
Pretty much any component of GDP in the fourth quarter is likely to be weaker than it was, with the possible exception of private investment, because that essentially went on hiatus in the second quarter in the immediate before the election and afterwards. But pretty much everything else, quarter to quarter, is going to look weaker.
You said just now, Don, that revenue loss from consumption is going to be a big deal for the government to contend with in this fiscal year.
Yes.
Do you think that there is something that they can pull out of the rabbit
It's not
hat?
this fiscal year. It's next fiscal year.
Next fiscal year, okay.
Yeah, this fiscal year, as Suhaimi already said, you've got a benefit relative to the budget for 2018 from higher oil prices. Yeah, and you've so that actually kicks in and helps you out. So you've also, and you will get some revenue back from the loss associated with the SST. So those components mean it's not hard to hit the budget deficit for this year. You're also going to lower some of the expenditure that you otherwise would have had. So it's not a 2018 budget problem. It's the prospective budget in 2019 where things get more complicated.
Let's talk about the big figure that people tend to focus on when we talk about budget, the oil price that the government sets as a target in preparation for the budget. We've seen the government revised the budget, the price of oil to be from 40 plus to 50 plus, and now today it's hovering above $80. Do you think that the government is going to have a very optimistic view in terms of how the prices of crude oil is going to be, and perhaps because of that they're a bit buoyant in how they're going to manage the, I'm sorry why we're spending so much time on the budget, but because this is a big thing, do you think that this is something that the government is going to look at in terms of how to prepare the budget accordingly?
I think we have to be realistic.
And so does the government.
Yeah, so is the government, because oil-related income is no longer a big chunk of government revenues. It used to be as high as 40%. Now it's come down to less than 20%, probably about 15, 16 or 17%. And I guess at this point of time, nobody is really looking at the idea of a crude oil price going back to $100, $150. Of course, they are the concern. But everybody is still taking a moderate view in terms of the direction of crude oil price. So I guess there will be some benefits to the government coffers from the increase in crude oil price, but it's a smaller portion of total government revenues now. So governments still have to look at what can they do in the short term and the longer term in terms of whether or not they want to consider new taxes like the idea of soda tax that was implemented, but I'm not so sure how much can be derived from that. I doubt it very much they would raise corporate or income tax at this juncture, but I don't think they have rooms to cut those either. So, you know, the issue is what kind of options that they have. Now, as I mentioned earlier, at least for next year or maybe next few years, asset sales seems to be one of the key areas. So I'm saying that watch the non-tax revenue part, what they're going to do. It seems to me, for example, the changes that happened in Khazanah recently seems to provide some indication or hint of how the government going to raise revenue through non-tax sources.
But Suhaimi, you've got to be careful with that, right? Because that's an asset sale. So if you did the formal accounting and you were a company, that's not a revenue number. That's a change in the balance sheet. And you need to take that against debt. Counting that in as a revenue stream against current expenditures is a recipe to go broke.
I mean, you know, you're talking about balance sheet. He's talking about, you know, profit and loss here. We're talking about two different books.
Well, one of the things the government should do, and is, I understand, preparing to do, is actually present a balance sheet. Because part of what was going on that spooked the market with the 1 trillion in financial liabilities.
Day one of the taking office, mind you. So
is, well, hang on a second. Which company publishes only the balance sheet, only the liabilities, not the assets and not the net worth, right? No one does that, right? So let's get the full balance sheet out there. And then the issues around, well, what assets are there? How do those back? Which ones are liquid? Which ones can we afford to sell? Because at this point, the private sector can take on those operations more effectively. The social role is not critical. And we can then either temporarily subsidize expenditure or reduce some of those financial liabilities.
All right, we'll take a short break, but when we come back, we'll discuss a little bit into how companies in Malaysia, particularly sovereign wealth funds, for instance, tend to invest next year. Don't get it back. Welcome back. Today we are with three economists from Maybank, RHB and CIMB talking about the prospects of the nation's economy. There's something that we haven't touched yet, which is the ringgit, and something that has been perpetually my interest is on why big investment bodies like QAP and EPF, they don't tend to spend so much of investments overseas. Perhaps it was because of the previous government's way of doing things. But do you think that the time is right for investment companies, including PNB for that matter, spend a little bit more time in investing in overseas assets, anywhere from fixed assets to even equities?
I think obviously for the government-linked investment funds, there is a need for them to diversify their investment portfolios. I guess the issue here is when they are quite heavy in terms of investment domestically, and this has raised some issue in terms of market operation, in terms of floats, liquidity, concentration of shareholdings in the hands of these companies. But we also, this is an area where we also need to wait for greater clarity from the new government in terms of what are the mandate for these government-linked investment funds going forward, whether the government will still want them to focus on investing domestically, or will they be given more leeway to look at opportunities abroad. I guess for certain funds that already have sizable investment overseas, probably not much of an issue. The question is probably more for the funds that are just beginning to kind of put their toes into waters overseas. So there has been changes in some of these institutions in terms of leadership. So we need to see what kind of direction and mandate that the new government is going to provide for these entities.
There's also a need to, I think, to distinguish between the objectives of the different investment management entities. Those which have a public pension and need to generate a return in order to meet the obligations associated with those pensions. That's an easier structure to say, well, what we need to do then is look for the best return that we can get. And that is some bundle of domestic assets and foreign assets. And we'll make a judgment within the confines of trying to generate the best return for the pensioners who we are obligated to
yeah,
to
that's
meet
the
those
thing.
obligations
You
for.
touched on a very interesting subject, pensioners, right? In this sense, government pension, co-op.
Yes.
A few weeks back, the finance minister said something quite interesting. The consolidated account of the government dropped 96%. He was asking the former prime minister to justify why the drop was there. But I wasn't too concerned about that figure, from 11 billion to 400 million. I was a little bit more concerned about the addendum statement that the finance minister made. We have to allocate 8 billion ringgit per month for pension funds. I'm no economist, I'm just a TV guy. But is that sustainable? I mean, 8 billion bucks per month. Do we need to really look quite extensively into how we manage our funds?
The other way of thinking about this is, you go back to the balance sheet issue, is there's a contingent liability, which is all of those future retired civil servants need to be paid.
Yeah.
Now, you don't need $8 billion every month ad infinitum, but there's a relatively large chunk of assets that need to be injected into QAP in order to meet the obligations on the basis of the contract.
What's the rate again of contingent liability right now? It's 55%, or it's more than that, something like that?
Oh, well, there was the question was whether or not that included the numbers associated with QAP, or whether those were associated with other government-linked corporate companies.
Okay.
We don't have the detail to be able to say that. But of course, that's again why you want the balance sheet that says what assets do we have, and when we have a more complete accounting, then it's easier to structure a set of policies that manage those cash flows over time.
Let's talk about something a little bit more interesting and outside of your comfort zone. Let's talk about political risk. Talks are very, very rife in terms of Malaysia getting a fresh new prime minister very soon. I know Ibrahim is already making various statements that he's ready to take over the mantle of leadership of this country as early as this year. He is contesting the by-election this weekend. Do you think that this has any bearing into how economists such as yourselves are going to look at things?
Well, I think as far as I'm concerned, what is most important is whenever that happens, and I'm not going to make any speculation as to when that's going to happen. As far as I'm concerned, our forecast is based on the 2-year deal that was made. I'm more concerned or more interested to see that the next political transition in the country happens smoothly, like what happened after the 9th of May general election. I think that is most important, because as you know, market don't like uncertainties, and political uncertainty is one of the things that investors priced in when they make their decisions and will have an implication on the economy. So as far as I'm concerned, the most important thing is the next political transition that's going to happen in the country happens smoothly.
Isn't that one way of looking at things, where succession planning is in place, where we have the prime minister, incoming prime minister? Wouldn't that excite the market or calm the market down?
Well, succession planning assumes that there's not some uncertainty. You have a democracy in which you want to reflect the will of the people at the time of that election. So within individual political parties, you want to be able to groom the future leadership such that were you to come out successful in an election, the market and the population at large knows what's coming. Yeah? But to succession plan for the next 60 years, for example, I think is actually detrimental, because it creates this the problem that if you lock something up, right, what is it going to unstick, and are you going to get big disruptions from the unsticking? And that's why the aftermath of the May election has been so, I think, supportive of the general perception about political risk in Malaysia not being high as a result of so far being able to have a discussion about fiscal policy and not about violence in the streets in the aftermath of the political change.
For my part, I'm really looking forward for this conference that's going to happen on 9th of October, Malaysia New Dawn, which is obviously co-organized by the 3 banks, doing a bit of advertisement here. But it marks the beginning of a few series of key events between now.
The payment after the show.
Sure. What you call key events that's going to happen. After the conference on 9th of October, we're going to have the tabling of the midterm review of the 11 Malaysia plan on 18th October. Then we're going to have budget 2019 on 2nd November. I think these events are important as we hope and expect it to provide more clarity on the longer term economic policies.
All right. Thank you very much, gentlemen. I have been speaking with three distinguished gentlemen. Suhaimi Ilias, Group Chief Economist of Maybank, Dr. Don Hanna, the same title I suppose, Group Chief Economist of CIMB, and of course Vincent of RHB. If you want to catch more of this interview, just head on to astroawani.com and search for Awani Review there. That's it from me. Thanks very much and goodbye.